The most important source of information for evaluating the financial health of a company is its financial statements, consisting principally of a balance sheet, an income statement, and a cash flow statement. Although these statements can appear complex at times, they are all rest on a very simple foundation. To understand this foundation and to see the ties among the three statements, let us look briefly at each. A balance sheet is a financial snapshot taken at a point in time of all the assets that the company owns and all the claims against those assets. The basic relationship and indeed the foundation for all accounting is, or commonly known, the balance sheet equation is assets equals liabilities plus the shareholders equity. Remember this basic equation. So what the company owns, called assets, and what it owes, called liabilities, the accountants call the difference between the two shareholders equity. Shareholders' equity is the accountant's estimate of the value of the shareholders' investment in the firm, just as the value of a homeowner's equity is the value of the home, the asset, less the mortgage outstanding against it, the liability. Shareholders' equity is also known variously as owner's equity, stockholders' equity, net worth, or simply equity. It is important to realize that the basic accounting equation holds for individual transactions as well as for the firm as a whole. Thus, when a retailer pays 1 million in wages, cash declines 1 million and shareholders' equity falls by the same amount. Similarly, when a company borrows 100,000 of cash rises by this amount, as does a liability entitled something like loans outstanding. And when a company receives 10,000 payments from a customer, one asset, cash, rises while another asset, accounts receivable, falls by this amount. And here we have a great example of consolidated financial statements. These are the financial statements for Daimler, which is commonly known Mercedes. As we did previously, we had an example about that. And obviously, you already know how to get them from annual reports or directly on their webpage. So this is the income statement. Right now, it's not part of the lesson. But in here you will find the consolidated statement of financial position. So accountants list assets and liabilities on the balance sheet in order of decreasing liquidity, where liquidity refers to the speed with which an item can be converted to cash. Thus, among assets, cash, marketable securities, and accounts receivable appears on the top, while land, plant, and equipment are toward the bottom. Similarly, on the liabilities, short-term loans and accounts payable are toward the top, while shareholders' equity is at the bottom. You might see in here IFRS might change the order from equity and liabilities. This is a great example, but at the end you can take a look. It does respect the order of liquidity among liabilities or debt between long-term debt and short-term debt. Inventory, for example, is a current asset because there is a reason to believe it will be sold and will generate cash within 1 year. Let's find the inventories. In here you have it in the current assets. Accounts payable are short-term liabilities because they must be paid within a year. Finally, shareholders' equity, a common source of confusion, is the large number of accounts appearing in the shareholders' equity portion of the balance sheet, beginning with the common stock and ending with treasury stocks.